Hey, what's up? I'm Russ, the #1 YouTube channel by a welder named Russ, sharing their passion for passive income. We're gonna dive into a 123-year-old company with a tempting 10% dividend yield. But after some positive news pushing the share price up, should you consider buying it? Quick few words first. I would love it if you would share your thoughts or experience on the dividend stock that we're gonna be talking about. And if you click the Blossom Social Investing link below, you can sign up for free and follow my trades and portfolio in real time. And do you know who else is on Blossom? You got Ryan Williams, Ian Lopik, and Mike the Dividend Guy. And speaking of free, I also have a weekly newsletter in which I share my thoughts on life, financial experiences, and of course, dividend investing, as well as the weekly portfolio moves and dividends received. Walgreens, ticker WBA, was founded in Chicago in 1901 and has been around for 123 years. Now, for decades, it was a steady performer with a strong moat, which is a term for a company's ability to maintain competitive advantages over its rivals. Walgreens built its empire on the concept of the corner drugstore, making it really easy for people to pick up their prescriptions and grab everyday items in one stop. They expanded rapidly, focusing on prime locations and efficient operations, and innovative services like drive-through pharmacies and 24-hour stores set them apart, building a loyal customer base and a strong brand. But times are changing and it's not in Walgreens' favor. I can hear some of you thinking, but Russ, Walgreens has been around for 123 years. Surely it'll bounce back, right? Well, I want to share a little bit of wisdom from economist Herbert Stein, who said, if something cannot go on forever, it will stop. Now, this applies to companies too, and just because a business has been around for a long time does not guarantee its future success, because companies can and do fail even after decades or generations of success. It's just that we don't know exactly when that will be. So let's talk about that eye-catching 10% dividend yield, which sounds great, right? But there's a catch, because that's what we call an accidentally high yield, meaning that the yield isn't high because Walgreens has been raising their dividend for quite some time. Instead, it's because the stock price keeps falling. And what you need to remember is that when the stock price drops, the dividend yield pops. I can even hear some of you thinking, hey, everyone needs medicine, so how can a pharmacy be in trouble? Well, it's not just about the pharmacy anymore, because Amazon, Target, and Walmart are eating Walgreens' lunch when it comes to everything they sell. I mean, don't take my word for it. Listen to what Agree Realty CEO Joey Agree said in their Q2 24 earnings call.
Great question. We've talked extensively over the years, and there's a slide in the deck about our dissatisfaction with Walgreens' both business model and performance. What we're looking for in a 21st century suburban pharmacy is one of three things. A high-performing store that's generally doing over $12, $13 million with limited competition, a ground lease, or a basis that makes sense in the 21st century omni-channel world. So you will not see us make any incremental investments in Walgreens. Obviously, we've gone from over 40% in 2010 to negligible today for a reason. The only pharmacy we're interested in is CVS.
I mean, he put his money where their mouth is, because check it out. In 2012, Agree Realty had 30% exposure to Walgreens, and by 2021, it was down to 1%. So the writing has been on the wall. Now, I want to break down some key numbers for you. And one important metric is the return on capital employed, or ROCE, which shows how good a company is at generating profits from its capital. And we typically look for a 5-year average return on capital employed of over 20%, which indicates a strong company that likely has some sort of a moat, or as Warren Buffett says, a durable competitive advantage. And unfortunately, Walgreens is hovering just above 3%. So to me, this suggests that they don't have any kind of a competitive edge. We'll take a spin through some more numbers here on SimplySafeDividends.com, but I should mention this to you, that it's a fantastic site, and you can try it out for 2 weeks for free, no credit card needed, anything like that. So It can be a little bit pricey, but give it a whirl and see what you think. And SimplySafeDividends.com does give Walgreens Boots Alliance a dividend safety score of 20. Very unsafe. How quickly things change, because during the last recession, Walgreens increased their dividend, and their dividend had been growing for many, many years until they cut it 48% in January of 2024, where it went from 48 cents a quarter down to 25 cents. I'm not a fan of this, but you can see when they were having a little bit of trouble, they had a 0.4775 cent quarterly dividend, and they raised it to 48 cents. Microscopic, just to keep that streak alive while they were treading water. Simply Safe says on the valuation that their share price looks speculative. So watch out. And the market is telling you something's going on, because that dividend yield is 9.38%, which is way above the 5-year average of 4.65%. Now, the free cash flow payout ratio is what I love looking at over earnings per share, because check that out. Earnings per share payout ratio, hey, 43%, right? But when you look at the free cash flow payout ratio, it was 1,175%. Now it's negative 292%. Why is it negative, Uncle Russ? Well, that's because they have negative free cash flow per share, which is a whole big bucket of yuck, and we give that the Mr. Yuck stamp of disapproval. Now, they are supposed to have positive free cash flow per share, but that's because they're going to be closing about 1,200 stores over the next 3 years and plowing that money, whatever they're going to save, into more profitable stores that they have. But their earnings per share has been dropping, and you see their earnings per share growth already started going negative before we had the COVID shutdown, so there's been issues with Walgreens for a minute. They've stopped buying back shares, which I would hope they would do, because they got a lot of work to do on the business. Their total sales are still going up and to the right, but that means jack squat, because almost all their margins are either at zero or negative. Big old bucket of yuck. This is a gross situation for Walgreens. And the cherry on top, their net debt has been climbing, so they need to repair that balance sheet. And the interest coverage ratio, which tells us how many dollars of operating income they have to cover the interest on the debt. Currently, Walgreens has a very scary, it's almost Halloween time, 36 cents of operating income to cover every $1 of interest on the debt. That is no bueno, ladies and gentlemen. And if you are considering buying Walgreens just for the dividend, which, mind you, has already been cut, listen to what CEO Tim Wentworth said on the Q4 24 earnings call.
We are going to continually evaluate our situation broadly. We are highly committed to being efficient with our capital and to doing the things that you've already heard us talk about. And we will absolutely continue to monitor and make changes to our capital allocation, including better aligning our dividend with our long-term earnings power if we believe that that's the appropriate thing to do. And again, that requires meaningful discussion with our board on both our long-term plan as well as the dividend that we're paying right now. And those conversations, as you saw early in my tenure here, are continual. And so I don't have any news for you today.
Translation: we might cut the dividend, but we're not going to say it outright right now. Classic CEO speak, am I right? Well, if you're thinking, what else might you invest in instead? I have a few ideas to share with you. First up, CVS. They're in a similar situation to Walgreens, but check it out. Their CEO, Karen Lynch, just stepped down. She's being replaced by David Joyner. The company withdrew their 2024 guidance, announced 2,900 layoffs, and their stock is down nearly 20% this year. But they might be a better long-term investment due to their diversified business model and the fact that they acquired Aetna, which gives them insurance business that Walgreens doesn't have. Second, you know I love Costco. Really impressive dividend growth and safety score of 99, though I think they are currently overvalued and I'm waiting for them to drop to around $700 a share before I start a position. And number 3, Agree Realty, ticker ADC, which is a REIT with a solid yield and dividend safety rating. They currently look reasonably valued, and you can be a landlord to such great companies as Walmart, CVS, and yes, Costco. I get the appeal of that 10% Walgreens dividend yield, but remember, chasing yields without understanding the underlying business can be really risky. Instead, we should be focusing on quality companies with growing dividends. And while a 10% yield isn't as exciting, it's often a more reliable path to long-term wealth building. The key takeaways are a high dividend yield can be a warning sign and not an opportunity. Companies with a really long history can and and do fail. Just look for businesses with strong competitive advantages and solid financials. And I think some alternatives to consider are CVS, Costco, or REITs like Agree Realty. And remember, in investing, just as in life, if it looks too good to be true, it probably is. Hey, if you got value from this, hit the thumbs up, consider subscribing, and if you are a beginner investor or just somebody who loves stories, I spoke with finance professor and author Stephen Forster, who wrote the book Trailblazers, Heroes, and Crooks: Stories to Make You a Smarter Investor. And if you click this floating little box next to my head, you can check out our conversation over there. See ya!